Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Happy New Year, everyone. Welcome to today's Top Stock Pick segment. I am Jeremy Mullen, and I will be doing DocuSign, ticker symbol DOCU. The stock is a Zacks rank #1 strong buy that provides electronic signature software in the United States and internationally. Before COVID, I personally used the service only a couple times to sign various documents. But during the pandemic, I seem to be using it all the time, from anything from compliance documents to real estate signings. DocuSign became a go-to for individuals and businesses to digitally prepare, sign, act on, and manage agreements. Now, COVID helped push the stock to $315, but now Docu is trading under $60. From a long-term perspective, current levels look attractive after the company posted a solid earnings beat in early December. While I don't see the stock going all the way back to 300, I do think we can rally from here, so let's dig in and see why that might be the case. Okay, here's the profile page for DocuSign. Some facts about the company. It was founded in 2003 and headquartered in San Francisco. It employs over about 7,000 people and has a market cap of $11 billion, which you can see right here. The company serves enterprise, commercial, and small businesses to whom it sells products through direct, partner-assisted, and web-based sales. The stock has a Zacks style score of B in growth, but F in value and D momentum. Now the F in value, if you come down here, look at the forward PE, we're about 29, which for a tech company isn't high, and this is well off its highs that it was last year, but we still have an F value score. So with that, no dividend for a growing tech company. Looking at the next screen, we're going to dig into the recent earnings. Now, 2022 was a very rough year. As you can see, we had that quarter in 2021 that made the highs, but then Q4, investors just kind of saw the slow growth coming. I think they guided in here too, which led to this bleed in the stock and the subsequent quarters where it just didn't get any traction. We can see it's 0%. They met expectations here, missed expectations here, a small beat here. And then last quarter, we actually got a nice 39% beat here, which was the largest one since the stock made highs back in 2021. So that was a nice surprise. Looking into that quarter, DocuSign got a Q4 revenues about as expected in a range of $637 million to $641 million versus the $640 expected. The company raised their fiscal year 23 revenue guide to $249 to $250 billion versus $248 billion, so a little better there. Billings were up 17% year over year, while subscription revenue was up 18% year over year. Now, what are the analysts saying? Let's look at the estimates here. You can see over the last 30 days, pretty nice. A lot of analysts are upgrading here, and you can see that reflected in the numbers down here. For the current quarter, we have a 40 cent to 53 cent hike, which is about a 32% hike in estimates. We have a 17% hike here. Looking into the current year, another 17% move, and then next year we see a move from 180 to 215, about 19%. So nice raise in estimates from the analysts after that quarter. Shows a little bit of momentum in earnings. After earnings, a lot of analysts, for the most part, remain neutral on the stock. Multiple firms stuck with their hold or neutral ratings. But more recently, Citigroup reiterated its buy rating and took its price target to 72 from its previous 59. So this target is about 30% higher from current prices. So there's some opportunity there according to Citigroup. Now let's look at the charts and see how we can get there. Okay, here is the chart going back to 2020 and that move higher due to COVID. As I said, everybody was starting to use DocuSign. So we really saw some nice earnings and growth here, and then we topped out. End of COVID meant end of that growth, and investors saw it coming. And now here we are, all the way down to that $50 to $60 area, which is below the pre-COVID levels. So it's very interesting that it's come all the way back despite all that earnings growth. A lot of tech stocks that were involved with the surge of COVID have made similar moves. The key, though, is the earnings turnaround, which, as we talked about, kind of changed things. So let's zoom in here and look what happened. So you can see that quarter and the stock really popped nicely from the $45 area to 60. Now, the blue line here is the 50-day moving average, green line 21-day, and the 200-day. So as you can see, over the last couple of years, the 50-day moving average has been a place to sell. We got over here a little bit, but we made new lows, and another sale, another sale. But after this earnings, we popped over significantly over the 50-day, and this 21-day moving average has become temporary support. So it really looks like we could continue on higher to that 200-day moving average. Zoom in some more. What I have here is a Fibonacci setup from the lows made before earnings to the post-earnings highs. We got a nice pullback into a 50% retracement, which held basically once, twice, three times, and we're trending higher. Two scenarios that might fold out. We might just, if the market cooperates, go straight to this 200-day moving average. I like to put my targets at negative 23.6% in these retracements. So if we could get here, that's where the bulls would likely want to take some profits, and the bears might look to short the stock again if they want to initiate new positions. The second scenario is if the market does continue a sell-off early in the year, we could come to this retrace, the 61.8% retracement. So this is lined up with the 50-day. So I'd want to see this hold for a move back up to recent highs and then eventually take that out at some point over the next couple of months, hopefully before the next earnings. That would be the next catalyst that would put us up or down if we could see another quarter like this. So that's what the chart is, looking kind of bullish right now. A lot of beaten down tech names from last year will rally this year, but in order to do that, the earnings momentum they lost last year has to come back. DocuSign is one company that has already turned that momentum. If the overall stock market gains some traction, there's no reason we can't see double-digit returns early this year. Okay, that's it for me and my top stock pick, DocuSign. Here is Ben with his.
Hello everybody, Ben Rains here. Today I'm looking at JBill, which trades in the ticker JBL. JBill provides manufacturing services to companies in the telecommunications space and many other industries. The firm's client list includes the likes of Apple, SolarEdge, and giants in critical and game-changing industries all over the economy. JBill prides itself on operating in the background, working with hundreds of the biggest brands in the world to help make everything from smartphones and home appliances to healthcare and automotive tech. JBL is also set to benefit from the broader onshoring/reshoring push from U.S. companies and the federal government. JBill provides diversification that helps grow for many years, including 14% growth in fiscal 2022, which is highly impressive for a company that went public back in the early 1990s and was founded long before that. The company also topped our Q1 FY 2023 earnings estimates on December 15th, and our Zacks estimates are calling for its revenue to climb another 3% in 2023 and then another 3% in FY 2024 to hit above $35 billion. This would come on top of 12% average revenue growth over the last 5 years and roughly match its year-over-year growth during a multi-year stretch prior to that recent outsized growth. JBL's adjusted earnings are projected to climb 9% in 2023 and then another 6% in 2024. Plus, its earnings outlook has continued to improve for FY 2023 and FY 2024, which is no easy task as the overall outlook for the S&P 500 earnings and economy continue to fade. JBL's bottom line positivity helps it land a Zacks ranked #1 strong buy right now. It's also part of the electronics manufacturing services industry that currently ranks #1 out of over 250 Zacks industries, which is always a great sign for a stock. Plus, 6 of the 7 brokerage recommendations that Zacks has are strong buys. And the company also pays a nice tiny dividend that's yielding about 0.5% at the moment, which is nice for a growth-focused company. The stock has climbed about 30% in the last 6 months, and it hit fresh highs in mid-December. It has pulled back from those levels, which is nice, and it currently trades about 20% below its current average Zacks price target. JBL's recent performance is part of a 150% climb in the last 5 years versus the tech sector's 40% run and a 410% climb during the last 15 years compared to 180% for the Zacks tech sector over that stretch. Despite that long-term and recent performance, JBL trades at over a 50% discount to the Zacks tech sector at 8.8 times forward 12-month earnings. This also represents a huge discount compared to its own 15-year median and well below its highs of that stretch of 23 times forward earnings. So JBL appears to be a worthy stock to consider for 2023, given its valuation, resilience, alongside its ability to grow even as the US and global economies face recession fears. So that does it for this episode of Top Stock Picks. Make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more.